Ladies and gentlemen, good day and welcome to the CMS Info Systems Limited Q2 FY26 earnings conference call hosted by Asian Market Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sonali Gandhi. Thank you and over to you, ma'am.
Thank you, Trisha. Good afternoon, everyone. On behalf of Asian Market Securities, I welcome the management and thank them for this opportunity. We have with us today Mr. Rajiv Kaul, Executive Vice Chairman and CEO, Mr. Pankaj Khandelwal, CFO, Mr. Anush Raghavan, Chief Business Officer, and Mr. Puneet Bhirani, Chief Operating Officer. I shall now hand over the call to the management for their opening remarks. Over to you, sir.
Thank you, Sonali. This is Rajiv. Good afternoon, everyone, and thank you for joining our Q2 FY26 analyst call. Many of you would have attended our second analyst day in Mumbai on September 30th, wherein we shared in detail the industry landscape, H1 trends, some surprises and challenges, and also the opportunities for FY27 with potential for FY30. Our youngest and fastest growing tech solutions business is growing rapidly, generating significant momentum. The Securance acquisition has closed, and the teams are now working together on both the go-to-market and the synergy implications. Our retail solutions and currency logistics business has had an impact in H1 from subdued consumption levels and extended rains, which affected rural income significantly. Our ATM management solutions business is going through a period of transition and churn, which has a bearing on growth and profitability in H1, but our competitive position, strong business fundamentals with consolidation will deliver growth in H2 in FY27. Order wins for the quarter are at 500 crores, most of which are fixed price contracts in nature and from leading private sector banks. October is off to a good start with positive news. And with this, I would like to now hand over this to Anush, our Chief Business Officer, to give you a more detailed business update.
Thank you, Rajiv. Good afternoon, everyone. The second quarter was a transitional quarter for us. The industry is still recalibrating after last year's consolidation, and that has temporarily affected deployment cycles and network utilization. Several large private sector banks have rationalized their offsite ATMs due to lower transaction levels, while the rollout of new BLA ATMs under PSU contracts slowed as some MSPs have faced funding constraints. Taken together, about 4,000 ATMs were temporarily inactive within our portfolio, which, along with weaker ATM transaction volumes due to extended rains, have led to a revenue impact of about 15 crores. Post the AGF issue, banks had reduced credit limits and exposure to certain MSPs. This has impacted the working capital cycles and increased our DSOs. We have taken a prudent provision of 10 crores in this quarter, a proactive step to maintain balance sheet hygiene while continuing to ensure we significantly improve collections and cash flows in H2. On the cost side, two factors come into play. First, people costs increased due to long-term wage settlements in key regions. We had to be extra watchful that these negotiations didn't cause any adverse ops impact. These multi-year agreements are now complete and will be offset through productivity norms over time. Second, operating costs were higher as we had maintained our full network during the quarter since the large PSU bank cash outsourcing contract closure was still pending. The RFP has since then concluded. As a result of both of these, our EBIT was impacted by lower network capacity utilization and a temporary cost overhang. Productivity drives and pipeline growth should bring our margins back to prior levels over the next 2 quarters. Coming to H2, there are positive developments. The large PSU bank cash outsourcing RFP has closed after extensive negotiations and represents a 500 crore incremental revenue over 10 years for CMS. Further, banks have reallocated volumes across MSPs to ensure better traction on RFP rollout. This gives us visibility of getting to 74 to 75,000 ATMs in our cash business by March of this fiscal year. Another major BLA tender for 4,500 ATMs, which are mostly an expansion and not replacement, was bid at prices which are very close to interchange levels. This is a clear sign of improving pricing discipline in the ecosystem. At CMS, we are also targeting a 6% improvement in pricing and realizations in our ATM cash business by March. In our retail business, volumes were softer during Q2, but recovered strongly in October with a 20% increase on a month-on-month basis. This is the highest since the pandemic. Our investments in gig operating model continues to scale very well and should expand to cover 20% of all retail points by March, strengthening both cost agility as well as rural reach. With clarity on deployments, new PSU contracts, and ongoing cost initiatives, we expect sequential improvement in both revenue and margins through Q3 and Q4. With that, I'll hand over to Puneet, our Chief Operating Officer, for an update on our Hawkeye business and operations.
Thanks, Anush. So, in our tech and payments business, we already demonstrated our tech prowess and solutions at the Analyst Day. We welcome all of you to come and visit our tech center at Mahape, Navi Mumbai. On our Hawk AI remote monitoring platform, it continues to grow rapidly and is on track to reach 50,000 plus sites by the end of the year. This started at around 30,000 sites at the beginning of FY26. On the enterprise side, our non-BFSI portfolio continued to expand. We have successfully implemented 1,300 plus dark stores for a leading quick commerce player and received an additional order for 500 sites. The pipeline for this business is growing strongly across NBFCs, insurance, gold loan, logistics, diagnostic chains, and others. In October, we achieved a significant milestone for a critical unified build and operate project at a PSU bank covering approximately 2,000 branches with extensive AI use cases. This represents one of the first large-scale integrated surveillance transformation in India and positions CMS strongly for large PSU branch monitoring RFPs in FY27. As we speak, multiple banks are expected to roll out these solutions at their branches in the next 2 years. The RFPs for over 35,000 branches are being formulated by the banks. This itself represents a huge 3,000 crore plus revenue opportunity for the industry. This makes us confident of achieving our Hawk AI target of 80,000 sites by FY30. Shifting gears to the operation side, we are doubling down on 4 key areas to drive transformation and bring about significant automation and cost synergies. First, rewiring our core operating systems to leverage machine learning to design routes and trips across the network. Second, carving out a delivery model for customers who value premium services. Third, given the large opportunity in retail, we are scaling up our gig operations with automation and control to provide cost flexibility and growth. And last but not the least, extensively leveraging AI agents and bots to automate workflows and customer service to deliver significant cost savings. I am excited about the impact these initiatives will have in supporting our growth and margin aspirations. With this, I would like to call upon Pankaj, our CFO, to talk about financial performance of Q2.
Thanks, Puneet, and good afternoon, everyone. Our consolidated revenue this quarter declined by approximately 3% from 627 crore to 609 crore on a sequential basis, primarily due to temporary dip in our ATM cash logistic volume. From segmental revenue basis, managed services and tech revenue increased by 5% sequentially from 258 crore to 271 crore. And cash logistic revenue dropped by 5% from 417 crore to 395 crore, linked to drop in ATM count and retail cash volume per point. Our PAT for the quarter was 73 crore, reflecting a 20% decline compared to 94 crore in the previous quarter, with PAT margin at 12.1%, a contraction of 280 basis points from the last quarter. This was driven by the flow-through impact of the revenue dip, temporary lower realization from the largest PSU bank customer, and higher provisioning due to increased AR on account of reduced credit availability to MSP ecosystem post-AGS. We are actively engaging with these customers to streamline the payment cycle within S2. In addition, there is an impact of higher wages due to signing of long-term wage settlement, which are renewed every 3 to 4 years. While we could have focused on reducing our network cost in H1 linked to delay of the contract and the business volume, we have to be careful that employee engagement remain positive and harmonious. In terms of our H1 performance, overall revenue saw a growth of 1%, while service revenue grew by 5% year-on-year basis, driven by performance of the service component of our managed services and tech business, which had an annual growth of 18%. The PAT for first half of the year stood at 167 crore compared to 182 crore in the same period last year. As part of our broader cost rationalization efforts and considering H1 performance, the performance-linked ESOP will not vest and incentive payment will not accrue to the leadership team in this financial year, as these are directly tied to PAT performance. This decision is consistent with our culture of accountability and ensure that leadership our rewards are aligned with the business outcomes and shareholders' interest. As projects go live this year for our tech investments, CapEx spend in H1 is 175 crore. Full year estimate of around 300 crore. You will remember we had deferred and curtailed CapEx in last year, FY25. On cash flow, H1 is seasonally weak in the terms of collection and DSO, resulting in the lower OCF in the first half of the year. The AR net of provision was 959 crore as on 30th September 25, which is lower than September 24 of 990 crore. However, temporary decrease in account receivable by 70 crore resulted in a negative OCF. Our historical 5-year OCF EBITDA has been average 70%, with majority of it accruing in the second half of the year. Our cash balance remains strong at 687 crore, in line with last H1 despite higher CapEx, increased dividend payout and payout for the Securance acquisition. We expect to return closer to our FY25 PAT margin level by end of this fiscal year, supported by incremental revenue from new contracts and network cost optimization initiatives. With that, I would like to invite Rajiv for his closing remarks.
Thank you, Pankaj. Let me summarize the key points for all of you. The SBI cash RFP has concluded and contracting and final approvals are under progress. As this project goes to live status, revenue from this outsourcing contract is an incremental 500 crore opportunity for us over the next 10 years. More importantly, this also creates a very good reference point for other PSU banks to outsource more bank-owned ATMs directly for cash management with strong companies. ICICI Bank is on track to become our second largest customer. Post-AGS, the bank shut down almost 3,000 offsite ATMs in H1, but they are working with us to rapidly deploy currency recyclers to bring back the network to earlier levels. With just these two contracts going live in H2, the ATM management solutions business should get back to growth in H2 and deliver double-digit growth in FY27. 3 other large bank RFPs across both private sector and public sector are expected to conclude in the next 6 to 9 months, which gives us further opportunities for growth for FY27 to FY30. The short-term pain in the last year, the collapse of an industry player, the credit taps being tightened for some MSPs, are eventually going to help the ATM industry consolidate faster. This is also creating a better pricing environment for upcoming RFPs. In the retail business, October has seen a strong jump in cash volumes, and we hope these positive consumption trends will sustain and continue in H2 with GST-driven reforms and demand. Our Hawkeye platform scale-up is massive. I want you to reflect on this business, which was created post-IPO in 2022, and this business has gone from a size of 0 crores to 100 crores in its first 3 years, and is now likely to go to 250 crore revenue in the next 2 years. We do see smaller players unable to compete, leading to consolidation. We will, on our part, continue very aggressive investments in the Hawkeye Tech platform to drive this high 50% growth CAGR opportunity, and for this to become a large part of our revenues. Tech investments are also higher and needed to transform our core operations, to reduce physical operating costs, and to create a strong tech moat to help in sustaining margin profile and give us more agility. Looking back at the beginning of the year, while we knew FY26 will be a softer year between FY26 and FY27, but H1 threw up surprises at the macro and industry level, which we have explained in enough detail. While these are unpredictable, our team has solid experience in handling worse situations. FY16-17, we dealt with demonetization, and FY21-22, we dealt with COVID. Each time we have prevailed, come out stronger, leaner, with higher market share to deliver strong growth. As a team, we are aligned with our stakeholders and shareholders. Pankaj has already detailed the non-vesting of performance ESOPs for FY26, as well as non-accrual of performance-linked compensation for the year. From a key near-term metric, the H1 services revenue of 1,125 crores should grow by 9% to 1,225 crores in H2. This will mean an overall FY26 services revenue growth of 8%. That run rate in H2 of annuity revenue will provide us with a very good base to hit our FY27 services revenue target of 2,700 to 2,800 crores, which is a 15 to 19% growth goal. With that, thank you so much, and we'll move to Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vedic Sarkar from Unifi Capital. Please go ahead.
Rajiv, hi, good morning. Tough quarter, and thanks for the detailed background and context setting. A couple of questions. Just so that I got your last comment right, did you call out that the combination of cash management services and managed services revenue will be about 1,225 crores in H2? This is excluding the hardware component. I'm sorry if that's a repetition.
Yeah, so I think, Vedic, if you reflect back on both the Analyst Day and the way we said businesses are merging into each other, we sort of are focusing on the annuity and services revenue. Services revenue will cut across all our business lines and will not include the product revenue.
Right. No, that's interesting. Thank you. So the SBI RFP that we've closed this quarter, right? So at the base case that tantamounts to about a 70 crore to about a 50 crore revenue potential per annum. But I also understand that we're already billing a part of that for services that we're doing, by measure of goodwill before the RFP was finalized. So my question, Rajiv, here is that what's the incremental revenue at stake here? Or is the entire 50 to 70 crore likely to be incremental?
Vedic, hi, Anush here. So I think if you look at the commentary that we've shared in the presentation as well as in the call now, the 500 crore that we're talking about is only purely reflective of the incremental revenue opportunity.
Okay, incremental. Got it. That's interesting. And some very interesting comments on the gig model, Rajiv. Could you please, flesh that out more and what that does from a fixed cost savings perspective? Point number one. And secondly, on the employee cost reduction that we've seen in Q2, how should we read this going forward? If you could just call out the cash, non-cash component, is this a one-time reduction? I understand the part of the ESOPs don't vest and probably you've added back some part of the incentives that would have accrued. How are you thinking about this line item going forward?
So, Benny, Anush here. I'll take the first part of the question on the gig and revert to Pankaj for the comments on the second part. The gig is really, if you go back and think about what we're trying to do on the retail opportunity, is to really sort of try and expand the market, which is to go beyond just the urban, semi-urban and expand it from the current 200,000 outsourced market to closer to a 500,000 market. All of this, of course, needs investments on the business side and being able to, create the new use cases using technology and solutions to integrate with retailers. From the operations and service delivery, it also needs us to create a certain agility in creating service delivery models in places where, our network perhaps doesn't exist, or the density of business points do not justify a large fixed cost network operations. The gig serves as a very useful way to drive growth into some of these under-penetrated markets. What Puneet spoke about in terms of using a lot of machine learning algorithms is to also constantly keep evaluating our network operations, looking at the density and deciding on a very frequent basis, almost on a weekly, fortnightly basis, what are the best sort of resources to deploy for the different types of business points. So gig becomes a very useful, almost, edge case scenario for opening up these markets. As they mature over a period, we'll evaluate what are the right ways to do it in, four-wheeler routes and what type of routes, for example.
And I just want to add to what...
Very quickly, the gig will probably be applicable just for the new business cases and not the existing centers of cash pickup. Is that right?
So I think overall what we will have to examine is basis the risk profile and what amount of money we have to handle and the network density and reach. We will start having more of our operations remote areas on a gig-based model, where we don't need to deploy the entire crew and all. But I think just step back a little bit again. I just want to add to what Anush said. If I go back 2 to 3 years, many times when you talk to we are working with banks only, right? When you walk directly to a retailer or a NBFC or a gold loan company, you can't go and pitch a solution and say, I can only do 600 branches where I have presence. The remaining you go figure it out. So I think for us, the idea is to say, accept whatever the entire network and then figure out how will we deliver it. For that, we have invested in creating gig capacity. That gig capacity will not always be profitable or will not, function fully in the first 3, 6, 9 months, but at least gives comfort to our direct-to-retail clients that we will support them end-to-end. And over time, we need to get faster in how we see how to make this network operationally profitable. And that's why the investments in ML and R are going in to be able to tailor our ramp-up, ramp-down in line with how we take business points.
Okay, and on the employee cost reduction bit, is this a one-off? I mean, how are you thinking about this going forward? I understand your comments on the ESOP and the incentive bit, but how should we model this, say, perhaps the next year and onwards?
I think the employee cost reductions which you're seeing in Q2, especially linked to the two things you talked about, are one-off, and therefore they won't obviously be cut. You won't see that in Q3 or Q4. However, as Puneet and Anush both talked about, I think we are driving very significant productivity. There are also employee cost increases which are in terms of more longer term through our LTS agreements. But I think we've already started off fairly intensive productivity and cost optimization efforts, which in H2, won't happen only in Q3, should help us make up for this.
So quantitatively, what does that mean? I mean, do we revert to a run rate of 90 crores a quarter, or will it be between 80 and 90 crores a quarter quantitatively?
I don't know that answer to that question right now. I think we also will not be able to forecast Q3, Q4 line by line costs right now. We'll tell you end of Q3, but I think our goal is to make sure that our EBIT and PAT margins are trending back to normal by the end of the year.
Okay. And just last two questions, Rajiv, thanks for bearing with me. The provisions that we've taken, is there incremental stress in H2 as well? Are we scaling down that business? How should we read that?
On provisions, Pankaj?
So in addition to our usual risk provisioning, we had taken incremental ECL provisioning due to elongated payments from certain MSPs. We are working closely with them to streamline the payment, and we expect that the normal risk provisioning plus ECL provisioning to be in the range of 4% revenue in line with our historical trend.
I think overall our MSP, from some of these MSPs, the revenue stream is about 8 to 10% overall revenue. I don't think we are looking to right now tailor it down, but we will control exposures. H1 generally, I think is just always seasonally very weak for payment cycles from banks to vendors to MSPs to us directly. H2 things always pick up. This year has been a little bit more tighter. I think, as I said, some of the credit offtakes have been lower, but we are working closely to get this under control.
Yeah, and just so that I know how bad this is, what's the aging here? Have we crossed 6 months on this 10 crores worth? What's the rough aging count there?
No, we provide on the basis of expected credit loss and the risk provisioning what we do for our cash business, and this is based on it is not only the MSP, overall because of the...
I appreciate that policy, sir, but just so that we're a bit more quantitative, I just would like to understand how bad is this? I mean, is this beyond 4 months? Is this beyond 6 months? Just a rough cut will do. I don't need the exact day count.
No, I'm saying the DSO level, Vedic, in H1 this year is the same as it was last year at this point. In September last year...
No, I meant, gentlemen, for this specific pool of 10 crores, obviously this is stressful, so, is this beyond 6 months? Is this beyond a quarter? So what's the quantitative breakup of that?
This 10 crore is basically between Q2 and Q3, Q1 and Q2, what is the incremental provision we have made for cash business, that this 10 crore represent that, and largely it is because of the MSP, the additional...
I think 6 to 9 months would be the pool of time. If you're talking, it'll be 6 months.
Yeah. That's what I'm coming for. And just lastly, if I just got one of your comments right, 3,000 crores of RFPs in pipeline. Did I get that right? And how should we imagine, this going down to CMS?
No, let me, I think Anush or Puneet will explain this. So if you specifically look at Hawkeye has a sub-vertical opportunity where bank branches are going to move to this level of technology for, surveillance, security, whatever they need to do. We had a very intensive project which is going live right now. We know there is many banks which are coming up and working on their RFPs. These are technologically fairly high end. All of them have consulting firms helping them come up with these RFPs. The pipeline of these RFPs will be roughly 30,000 or 35,000 branches. That will present an opportunity of a 3,000 crore revenue size for those banks, just for those 35,000 branches, to whichever companies are able to win in that. So I think it is specific to branch level remote monitoring solutions where Hawkeye is a leading contender.
Cool. I got that. And just the very last question before I get back in the queue. What's the scale of the payments business today, and what's the playbook here? So specific payment business.
Well, I think from the payments business right now, our payments business is limited to specifically what we do in our card management and card personalization solutions, however, if you go back to what we talked about in the Analyst Day, I think we are making very aggressive and active efforts through M&A to look at B2B, fintech, and payment type firms to see how do we expand our range of services to both banks and to NBFCs. So right now it is limited to what we do through card personalization services, which is roughly the revenues are reported separately anyways in our P&L. You can have a look. But in future, we hope this will grow through more technology and payment companies, which will be part of our overall network.
That's helpful, Raj. Thank you. Is it possible to quantify what the hardware part of our business might be in H2? I mean, because you've already called out the services part.
I think hardware businesses roughly, I think as a trend line are in the 10% zip code each year. The timing of this is not usually under control, but 10% of revenue roughly. But maybe we are overall, Vaidik, I think we are looking to have this as a lower percentage, so maybe 7-8% of overall revenue in this year.
All right. Got it. Thank you. I'll be in touch. Thank you.
Thank you. The next question is from the line of Vikrant Bendkar from Ashok Core Investments Family Office. Please go ahead.
Hi, sir. Good afternoon, everyone. So my question was regarding the three segments that you have, right? For ATM cash management solutions, retail cash, retail solutions, and technology solutions. How are the profile margins, profitability profile margins are defined in each sector, right? Because the businesses are completely different. Like the cash logistic business, you have like operational efficiency needs to be on top, and cost leadership is important to grow that business. However, whereas if you look at the technology side of business, the innovation part, the product differentiation comes into play. So how is the profile margin defined between these segments, if anyone can take up that?
So I think, first of all, the three segments we talked about, we will start reporting revenues by these segments by the end of the year. We've just finished our large ERP refresh, and end of the year, we'll give you revenue by the three businesses we explained to you in the Analyst Summit. Coming to profitability, I think it's not just profitability, also return metrics, ROCs. I think for us, every business, if you look at our overall 25% ROCE, I think there'll be some businesses a little higher, some businesses a little lower. But our overall aim is to create these three platforms which can self-fund their growth, and therefore need to have and sustain good margin profiles and good return metrics. As a principle, we don't normally invest in any project or a business unless we are able to see a minimum IRR of 18 or 20% in the business, and ROE in the 18-20% range, or ROC in the 20% plus range. We today cannot give you detailed profitability metrics by business simply because the entire network runs together. But by then, hopefully, we should have almost 80% of the network running independently linked to that business. There will still be 20% which will be shared, but at that point, we'll have a better sense of each business's operating metrics at that level.
Yes, just on that, just expanding this question, like how the capex is defined across these three segments. Like, is the management focusing more capex on the technology side of business going forward, as it is a growing business and needs to scale up accordingly to the management estimate of around 80K side. So is the capex going towards more of it, and are the return profiles matching with that for the technology business particularly?
Yeah, I think the return profiles on the technology business are very good. They're already very good and strong from what we can gauge from the numbers we look at. And that's what drives the investment case for us to approve it and for the board to approve it for us to keep investing in that. I mean, you look at the growth, right? I said 0 to 100 crores, 100 to 250 is the target. That will need investments. However, I think those investments are starting to pay off for itself. On the second point, I think for us, when you think about any capital allocation, whether it is in CapEx or any other area, I think we are looking at it. I don't think there is a priority on a particular area. There is not one business gets a little better approach. I think it is simply we compete. We look at what our capital allocation policy is. We also look at the project should fend for itself. And if you think of it in the last 1 year, we had opportunities for, let's say, having higher growth because in some of the ATMs which companies won and they could not deploy, certain banks came to companies like us to come and take up that project to deployment, and we evaluated it. We had the opportunity to get that business and growth, but we didn't think it would be sustainable in a 3 to 5 year period, and therefore we didn't take that up. So we sacrificed and we let go of growth, but we weren't confident of the return on the project, let's say specifically for the BLA segment. So I think for us, each project has to meet a threshold, has to have a margin of safety. I think all of our business lines are delivering good return metrics, so we're not concerned on this count.
Just to know that, are you considering like going forward, over the next year period? Do you see the technology business covering most of the a significant portion of your revenue mix?
No, it cannot. No, I mean, if you look at our overall numbers, we've talked about in the analyst deck. I think the overall technology sector we are saying should contribute by this year into roughly 10% of revenue. So can't we? I mean, You have to keep in mind that we do 75,000 ATMs in cash management, right? That's a huge revenue stream out there. It's almost 1,000 crores. So technology can't become 1,000 crores overnight, right? So
no, just it is 7%. So can it go to 15, 20 over the next period of 5 years? Just wanted to know that how it is a recent business around 2022, and it has scaled up to around 7% in around 3 years. So how are you looking over? Will it go to 15, 20%?
We are looking it to cross 10% by FY26, 27. If we get that going, I think the opportunity for it to hit 15% in the next 3 years is quite high. But you have to keep in mind, and I've said this from the last 3 years, our core businesses around ATM and cash also have been growing at a very good CAGR. So therefore, the contribution of these high growth businesses just starting from zero they can't become 30% because the other core businesses also are growing well. And
because there is double-digit growth in that also.
Correct. We do forecast them to also grow reasonably well.
Right. And just on the part of this Visionaire business, that because it has a large TAM around 8,000 crores as mentioned by you. Like the BFSI segment, you guys have the experience over 15-20 years in the BFSI segment. So the customer acquisition becomes easy in that. So the management is now targeting non-BFSI sectors and already win contracts in quick commerce and EV industries. So how are the customer acquisition costs different, and what are the major problems that management is facing in acquiring those non-BFSI targets, and is the cost benefit is aligned with that? Just wanted to understand that.
So first of all, I think for us in a technology-led business, there is a platform building cost which is amortized over all customers, not specific to any sector. Then there is solutioning cost, which is client specific, right? You customize solutions for a particular client. We will only customize, and there is investment in that. Some investments work out, some don't work out. But I think for our overall tech business, these are investments you keep making because you're building the toolkit, you're building AI use cases. They'll come in handy in other industries also. So I think for us, we are only right now able to tackle or cater to clients where there is a large footprint. Smaller clients we can't even go after. So unless somebody's got 500,000 locations, 2,000 locations, we don't even have the technical people available to build a solution case for them. And neither do we want to focus on it, right? We want to focus on large clients. I think a large client needs CMS. Smaller clients don't need CMS. I think they will have other companies they can work with maybe more effectively. So I think the cost for us, because it's a horizontal approach, think of it, there may be some use cases different, but a lot of the platform cost is fungible across sectors.
Right. And is the differentiation that makes this business go across, make the switching cost higher for the customer, or what is the case for that? The use case I'm talking about for the Visionaire.
I think it's a good question because in a technology-led business you can get disrupted significantly, surprisingly.
Right.
I think the way we do this is because there is capital involved. We only work with clients where there is significant lock-in periods, right? We at least have 5 to 7 years. Now, having said that, I think we have come ourselves and disrupted people here, right? Because we are the last to enter the sector in 2021. So I can't say that there won't be somebody else who can't do this. Tech businesses across any platform have that risk, and you have to live with that risk. What you can do is keep investing and innovating so that your solution sets are leading, are strong, are delivering value to the clients. I think what is the moat for us here isn't only just the tech, is that think of supposing you and I want to set up this business tomorrow, right? And we have a VC who gives us 150 crores, we go and start building this platform, we compete. What we both won't have was a CMS is a company present in 250 locations, is have 1,000 engineers in the field to fix things when things go wrong, which happens all the time. Many people deploy stuff, but nobody knows what the hell happened to the deployment and how do they go fix it when the last mile issues come up. I think our moat remains our network reach, client management, and also, frankly, the brand for large NBFCs and large banks to trust.
Right. And just regarding that, the H1 consolidated balance sheet, we can see that there is a significant increase in intangible assets, and in cash flow also there has been increase in purchase of PPEs and intangible assets. So is it regarding majorly towards this technology business, or is it spread across the three segments that you guys are doing?
We have acquired one company, Securance, in this period, and this is related to that.
Okay, got it. Thank you so much, guys.
Thank you. The next question is from the line of Krushi Parekh from Bugle Rock PMS. Please go ahead.
Yeah, hi team. So I just want to first understand that this decline in the business touch points, is it purely related to the ATMs because of so what is the reason for the shutdown of these ATMs, first of all?
Krushi, Hanush here. I think we detailed this somewhat in our investor day, but just to briefly summarize. Post the AJ situation, many private sector banks both used it as an opportunity, also looking at overall ATMs which weren't contributing meaningfully in terms of transactions. They pruned those estates down. So some of the large private sector banks at the industry level shut down large parts of their offsite ATM network, instead wanting to refocus on setting up new recyclers, either mostly in on-site locations. The second reason for that churn that we witnessed has been public sector banks which had awarded RFPs under mostly the brown label ATM contracts in last year to MSPs. Those MSPs, because of again the AJ situation, banks which had curtailed the limits and borrowing exposure to some of the mid-sized ones, found it difficult to have the capital adequacy to roll out these contracts. So through most of H1, we sort of dealt with these headwinds. As we come into Q3, two things have happened, which is, rollout of those private sector contracts have started gaining momentum. As Rajiv said, with ICICI Bank, who's soon, emerging as our second largest customer for CMS, we are well on track to deploying these solutions for them. The other set of banks who had given orders to some of these MSPs have reallocated that from some of the weaker ones to the other more willing ones, and those have the balance sheet strength to roll out these orders. So that sort of, led to that temporary decline of 4,000 ATMs in the last 3 months. But as we have come into October, we started seeing a pickup in momentum on ATMs coming back into activations. And by end of this year, around March, we think we should be able to make good the delta and create some growth for ourselves.
Okay, so Anush, just to understand, so a good portion of this pruning is behind us now, and we are now looking at a normalized rate of growth in the ATMs again?
Yes. So,
okay.
H2 versus H1 being a 9% growth, all of this is a contributing factor in that.
Okay. So just to continue on this particular point, now the thing is that again, just some certain grapevines and some other conversations in the industry, a good portion of these ATM sites are permanently out of the system is what the sense that we are getting out here. Okay, now. If say for next 1 year, 2 year, I mean, we do have some orders in hand, but if say for next 1 year, 2 year or if the banks are not willing to increase their ATM sites, is it there something that we have some kind of a plan B to ensure that we remain on some kind of a growth track in this?
Yeah, I think good points, right? So, you have to sort of look at, there is no one strategy or tactic being adopted by banks. I think it really depends on private versus public sector approach. For the private sector banks, what most of them are seeming to do is to shut down or reduce their exposure to offsite networks. Offsite ATMs know what private banks used to capture transactions on an acquiring basis. That is from debit cards which did not belong to their banks but from other banks. Over a period of time, with the growth of both public sector bank networks and white label networks, and the general decline in transactions, they have found this to be not a very attractive proposition. Instead, saying we'll use the capital and the bandwidth to refocus and invest into creating much higher quality networks in their on-site networks, which is the branch. So if you look at just to give you an example again on ICICI Bank, what they're trying to do is to remove all of the older ATMs that were there in their branch networks and set them up with new recyclers. Our engagement with them on setting up on our software solution of Algo multi-vendor solution is also to try and use this branch as a sort of a technology demonstrator for multiple activities that can be done beyond cash transactions alone in the coming period. And that's a theme that I think we will start seeing happening across other private sector banks. Public sector banks are still balancing between on-site and off-site. There is no goal there to either reduce ATMs or shut down anything. And when we look at the last year, year and a half, out of the top 5 or 6 banks in India, both private and public, most of the RFPs for these replacement has only happened on 2 of these largest banks. The next 3 or 4 all have going to come out with RFPs either for replacement or growth of their networks in the next 12 to 18 months. So I think to us that creates enough of a tailwind and opportunity. Also bear in mind that, I think we've addressed this earlier as well, that the CMS portfolio over a period of last few years has had a strong bias towards public sector banks because we were very late entrant to this market and consequently grew that business on the back of RFPs. Today, with private sector banks wanting to redo and refresh their networks, that becomes a very interesting opportunity for us to start engaging with customers who we haven't done so with so far.
Okay. So broadly, from what I understand, we are still largely dependent upon the trends that we have seen. It's a temporary blip, but hopefully H2 or maybe next year onwards, the lethargy in the system corrects and we start seeing the growth again.
Yeah, I'll just go back to what we said. I think there is a very strong growth opportunity within our core businesses. And I think Rajiv addressed this, and we also spoke about this in Investor Day, which is when we just look at the ATM market, the fact that most of the public sector bank ATMs are still not outsourced. The refresh pipeline of these ATMs presents itself as a very interesting opportunity. So, yes, you had this blip of 2. We see those ATMs coming back into circulation by Q4 and, also delivering some growth to us. That Q4 performance will give us a very solid base for FY27.
Okay. And one more question.
It's also a very consolidating market, right? And that sort of presents itself as a very interesting structural tailwind to us.
True. Just one thing also on the numbers, this capital WIP of 141 crores. So what would be the breakup of this?
I think we'll have Pankaj go through that and come back to you if we can sort of take up another question in the meanwhile.
Sure. So as of now, I'm done, but I'll be on the call for that particular.
These are the project under execution. Like we have around 1,400 crore rupees of the project under execution. So these are these WIPs, CWIPs related to those projects which are under development, execution.
So any particular projects that you are referring to on this?
Couple of projects we have already given, like UBI, etc., like branch UBI or some of the other fixed price BLA, etc. These projects are part of that.
Yeah, I think if you remember last quarter, we had about 1,500 crores of orders which were pending execution. This quarter, we won 500 crores of new orders. And the pending order book for us to execute is about 1,400. So, with such large order books which are both being executed and won, there's always, an element of work which has been done and pending approvals will translate into revenues.
Okay. Thank you. And any particular word on any acquisition size or on the acquisition side?
Work being done, we will obviously update only when we have something to offer. Right now, nothing.
Okay. Thank you, team. All the best.
Thank you. A reminder to all the participants, please restrict yourself to 2 questions. The next question is from the line of SK Devnath, who is an individual investor. Please go ahead.
Hello, good afternoon. I was really impressed by the effort for maintaining the result for business as it has been seen for last 12 quarters. I have some personal query, which is related to the ATMs only. As I find that with the increase of the digital transactions, how the ATMs expansion by the banks will take place, say 5 years from now, and it will impact our currency logistics business and ATM management business. How you plan to address the same?
Thank you, sir. I think for us...
Operator request has been initiated. If you'd like to cancel this request, please press *0 again.
Sorry. I should be audible, right? Hopefully the call is going on. So I think for the currency ATM business, first of all, if you look at both driven by public sector banks needing to access their reach of customers, their availability, banks need to have X number of ATMs available to consumers at all times. We think there will be some steady growth in the installed base. Interchange has increased by RBI in May, and the white label becomes an interesting opportunity where deployers are looking to increase ATM network in semi-urban rural. We are seeing higher usage of ATMs in semi-urban rural, and that's where we think the PSU banks and WLA operators can service us more. The private banks, as cost of technology remains lower and as people costs go higher, we see private sector banks deploying more machines within their branches as they refresh those branches. Now, from an industry today, I think the overall industry at a managed services level will have 6 or 7 players. We do see this reducing to maybe 3 or 4 companies over the next 3 to 4 years. Therefore, the revenue size and the pool size for companies will go up as smaller or medium players exit. As you have fewer players, the need for the service will remain. The transactions at the ATM may reduce. So if you used to go to an ATM twice a month, today you may go once a month or something. But you have to maintain and run this network like you need to maintain and run a branch. I don't think that is going to change in the next 5 to 10 years. And therefore, pricing, which you are doing when there are lesser competitors competing, I think will go up. So I think the volume growth may reduce in 5 years' time, but outsourcing from PSU banks and pricing should make up for it to keep continuing this at a 8 to 10% growth opportunity. Having said that, this is a business which was, let's say, 60% of our revenue some years ago, is now at about 50% of our revenue. And over time, as a retail business and a technology business grow faster, the share of this business will steadily maybe reduce, which is also the goal, which is to have more business lines which are able to help us drive growth. So I think for us, we look at the fact that, we have multiple lines of businesses. We look to expand into other services which we can cater to for our banking, NBFC and retail clients. And as we drive free cash flow out of our current businesses to invest for growth into new sectors, we should be able to maintain a reasonable growth profile.
That's fine. Thank you. I just would like to ask a layman's question. That is that how we are utilizing AI in the days to come? Artificial intelligence.
Sure. So I think it's a great question. I think for us, AI, we started with extensive machine learning and AI use for our Hawkeye platform, which is our remote monitoring solution. So we've been doing that for the last 3-4 years and investing more and more because a lot of the security surveillance and all we are doing through a Hawkeye solution is by agents and by AI and not with physical eyeball monitoring. I think that learning is now pervading into our core operations. Puneet explained that in his notes, saying a lot of our route network, where we go, what we pick up, how much we pick up, what's going on, how do we keep changing our routes dynamically basis either seasonality or demand, is all we are investing in machine learning based algorithms to help us drive the next level of operational framework. I think for our company of our size, this is a big investment, but for a company of size, given the amount of we touch 130,000, 140,000 touch points, I think it helps us apportion the cost more easily to drive better, better margins over time. So machine learning and AI is being used extensively in our core operational business. It's also in our BU, our business line on Hawkeye.
Okay, interesting. Thanks for sharing the information.
Thank you. The next question is from the line of Praveen Kumar from Acutus Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. I had a couple of questions. The first one was on the EBIT margin on the cash logistics business. You have attributed the drop to lower network utilization and the provisioning. So, but particularly looking at the network utilization part of it, how much of it do you attribute to the consumption slowdown versus these temporary factors which you attributed to in terms of some of the network being down currently? So could you throw some light on that in terms of, where do you see this heading in the next, in H2 and also during FY27? This was the first question. The second question was on what you referred to earlier about, private sector banks and others, particularly looking more at on-site ATMs rather than the off-site ones. So how do you see that impacting your revenues in your various segments? This movement from off-site to on-site, both in terms of revenues and some broad margin kind of profile of that. Yeah, thank you.
Praveen, Anush here. To your second question first, the easier one. I think broadly the switch from off-site to on-site, we generally view it favorably for the simple reason that, it's not so much about where the ATM is, but what is the nature of the outsourcing model. When banks would outsource in the off-site, they generally had a preference to move to a transaction-based model simply because the selection of the site was being done by the MSP and not the bank. Whereas when it switches to an on-site, this is more a bank seeking a higher quality of engagement with respect to how a branch ATM should be serviced. They want partners who are able to bring in that resilience, that robustness, and that quality of service of a very different order than what necessarily was being done at an off-site ATM. And that can only happen if there is predictability and certainty of revenues through a fixed price model. So we generally tend to have a bias for the fixed price over the transaction. Coming to your earlier question on, what has caused that dip in the revenue, as you rightly attributed from an EBIT perspective, it's a combination of, three things. The first being the impact on our network utilization. Generally, as we've spoken in the past, managing our network capacity utilization through, just running a very high quality of productivity management is something that we've been doing for many years now. Q2 created two unusual situations. The delays in the closure of this large PSU bank RFP, which meant that, till the time it didn't get closed out, we had to carry that capacity and consequently the cost. And the second being the temporary dip in ATMs, which basically meant that ATMs which were installed, taken out, and either were being replaced at the same site or being relocated to a different location from off-site to on-site. We knew it was going to happen. Now, the uncertainty was really in a matter of time. It could be a quarter, it could be 2 quarters. Now, for that short-term period, just trying to recheck the network and ramp up and ramp down the network and capacity and incurring restructuring cost is not really worth it. So at the end of Q3 and then Q2 and Q3, when we speak about this now, we believe we have a far better visibility to be able to make the necessary changes to our network capacity, both through cost reduction, business which comes back into our network, leading to overall margin improvements, and getting it back onto track the way it was last FY. You're right. This is on the physical side of business points impacting our network. The dip in the cash collections on the which are more consumption oriented in Q2 in retail have also impacted revenue. So if you look at our total revenue impact of about 18-20 crores, about 5 crores a month, 15 crores is what is attributed to the ATM side, and the rest would be on the retail. And as I shared with you earlier, in October, with spending coming back on the retail side strongly in a 20% increase month on month, we think that should lead to a recovery of this business as well.
So where do you see the cash logistics, the margin on that heading in the H2 and next year, and where do you some rough sense?
So as we said, by end of the year, we hope to recover that back to where we used to be before this. By end of
Understood. And your earlier response on the offsite to onsite transition. So one question I had, follow-up question on that was that for an on-site ATM, is it possible that bank might require fewer services and might want to do some of the stuff themselves? And does that lowers the pool of revenue that you can attack versus an off-site ATM?
Not really. In fact, if anything, it works the other way around. Conventional experiences data has shown that on-site ATMs tend to attract more number of footfalls simply because these are branches. More people go to transact there for various reasons. Banks are very keen to switch transaction from branch to branch associated on-site locations. It's extremely expensive for a bank to have people walk in to a cash teller and do any sort of a transactional banking activity. It could be cash related, it could be account related. A lot of that is what they want to transition to their on-site ATMs and recyclers. The only delta between on-site and off-site is really around rental and electricity, where in an on-site, because it's part of a branch, those are borne by the bank.
And when you referred that private sector banks are moving more to recyclers versus regular ATMs, how are you positioned in that in terms of the hardware? I mean, do you have, because you traditionally had more experience on the traditional ATM side versus the recyclers, so how do you see that impact?
Not really. I think, within the industry, the parlance is, CDs, cash dispensers for, what is traditionally ATMs and recyclers. But, outside them, we generally tend to use ATMs as a catch-all phrase to talk about both. We were one of the first initiators and pioneers of bringing recyclers also into the country. I think it was way back in 2015 or 14 when we won what was then the largest order for currency recyclers to be deployed across State Bank of India network. So, we have a fairly deep and well-entrenched history of going back. And, we really are a full stack solution in the space, right? From having the right product, from our partners, Yosung, to an engineering team which understands this extremely well, and servicing and solutioning. And more importantly, when we combine that with the software platform, the algo, the benefit of that in ways in which the bank is able to use a recycler and provide a whole host of additional services to their customers, including things like account opening, KYC, and various other non-cash related transactions, that can be a very powerful combination.
In fact, I want to add one quick point. If you think of specifically private sector banks, when they think about upgrading their branch networks and adding more recyclers, they are very hardware agnostic, really. They are very service focused, like service and quality. And in fact, we have one or two clients who would like us to not only work with our current hardware partner, but with more to become hardware agnostic. But they would like to prefer CMS to do the work irrespective of which hardware you're working on. Now, I'm not saying that's a trend for the whole sector and the industry, but at least one or two clients have been focused on that with us.
Understood. Thanks for the response.
Thank you. Ladies and gentlemen, in the interest of time, this was the last question. I would now like to hand over the conference over to the management for the closing comments.
Well, thank you so much for so many detailed questions. We thought we would have a more descriptive monologues from our side and hopefully it will reduce the questions, but I'm happy to hear them out and give you better clarity. As we said, October is off to a good start. We hope that trend bodes out well for us the rest of the year, and we hope to have a much better H2 to bring us back online for our FY27 goals. Thank you for your time, interest, and patience.
On behalf of Asian Market Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.